one. The FOMC just came out. We're seeing a bit of volatility here. We've been kind of consolidating all morning, right at this breakaway gap, which is now just a regular fair value gap. So, because we filled it. It could, to be honest, right now, we could either see some lower prices. We could also see higher prices back up to this breakaway gap up here. I'm more so interested in what the first half and second half of FOMC does. So until the last hour, I probably won't be looking, probably like 2:45. Until the last hour, I probably won't really be looking or interested in taking many trades. Now, what I'm seeing so far is we've been finding a little bit of resistance at this new day opening gap, sort of all morning. And on the regular trading hours gap, there is another gap there, all the way up here too. So remember that. We might not make it up there, but that's just there. That's an open area that we could potentially come down to fill. Or come up to fill, sorry. Looking at how the daily chart looks, not much movement at all. We could be very aggressive here. Powell may come and start speaking and saying things that really change the way price moves. It could make it more aggressive than I might anticipate it to be, and it could push it up all the way up here. It may also push it down right now. So right now I'm a bit more two-sided, but I'm only planning on trading according to my model. So that is to look for the midnight open, and if we're underneath it, I take shorts. If we're above it, if we're underneath it, I take buys. And if we're above it, I take shorts. We had a nice little run here beneath these lows that were relatively equal. Kind of ran up from there during lunchtime, early afternoon. I could have bought in and looked to get into that, but I didn't really see anything that I really liked taking that ahead of FOMC. I didn't want to take anything anyways ahead of FOMC. But it seems like right now we're heading up to make a high above the midnight highs. And this could then lead to a second half of FOMC, which runs price lower. And we just continue to run lower here. That is possible. I'm not seeing much upside at all this week, so it's like hard for me to sit here and say, okay, I want a market maker buy model, because that would probably demand a two-stage in the same direction of FOMC, meaning that the initial 2 o'clock statement release pushes price up, and then Powell speaks and pushes price up again. We would slice through this whole range, but we'd also be above the midnight open. I wouldn't like that as much. Preferably price would come down here to a discount, leaving relatively equal lows highs up here. This could have been immediate. No. This could have been an immediate rebalance, failing to get back this breakaway gap. So far, let's say like current bias, I wouldn't want to get back to this area here. I would rather see, if we're gonna go higher today, I'd like to see if this gap is gonna stay open and price not come down to it. You see prices, well, it became very aggressive. But, right, we seem to be still consolidating a little bit. This could demand even more price action when Powell comes on. Do you see this right here? That's a market maker sell model. How beautiful. Look at that. Wow. It's beautiful. Chill out, chill out. That wick looks too clean. That wick, I don't know. Relative equal highs here. It can leave it for a little bit, but I want price to come back into that. I sort of reprice into this wick a little bit. So let's take some of this off. I really don't like it when things that shouldn't be on the higher time frame are on the higher time frame. I have a problem with that. I know some people leave it on it, but I've seen some people talk about their charts and they're leaving their stuff on and not making it all clean. And it's like you go to the higher time frame and you're just like, what is happening in this chart? Because it's just so many things, you know. If I went back and I delete a lot of the things because honestly, my chart starts to lag. So I go ahead and I take a look at it and I delete it. Well, I have it all on picture anyways, but before I used to maybe if I go, let me find it on my other monitor. Okay. Okay, see, like before, this is from last year. When I was trading the S&P around this time of year in May. And so this is the 15-minute chart. Now, I think everything here is like a 15-minute level. On the lower time frame, see a couple of these things, no. I did not like that because on the lower time frame, there's a lot more. So this is, there's a lot more stuff. And I did not like it getting all cluttered. As you can see, at one point, if I opened this on my Chromebook, I mean, I could not, see some of this 5-minute stuff. Yeah, I could not load up the chart. Like, it would just not let me load up the chart because it was just so slow. And so I ended up having to just create a new template. I just closed TradingView as a whole. I had to create a whole new template and just start fresh, which was not so fun. Well, no, actually it was fun. It was time for me to make a new template. It was getting all cluttered. But anyways, yeah, keep your charts clean. And I also need to log back into my broker. Okay. See, now my broker is being stupid. What? I found it. I apologize for that. But yeah, I don't really like it too much when too many things from different time frames are cluttering the charts. But anyways, let me get back to this, and I'm gonna take a look at how the other assets are doing. See how well we're moving. But on the 4-hour chart, start there. I'm gonna try and find an inch. I did not log back into my broker. No, I did. This is a different chart. But I saw this morning with the Dow. See how the Nasdaq's making a higher low, and then the Dow made a lower low there. So the Dow's a little bit more bearish. Nasdaq seems to be the one that's bullish, leading, which is good, and it could turn into the bearish one later in the afternoon. So far though, on the lower time frame, so if I look inside of this area, I don't see any SMT as of now. So there's also SMT at the highs there. One of these is fake. So either the lows or the highs are fake SMT, because SMT would be indicating a reversal. If we had SMT here at the highs with the higher high and the lower high with the Dow, right? The Dow is obviously signifying that it is the more bearish one here. Though the Nasdaq is the one that's showing that it is, and the S&P 500, both of those are strong, and they're showing that they want to go higher. Now that could change, right? Because these are indexes. Now a lot of these have similar companies. Dow is typically the slower moving one, so it has some big companies that make part of it, and then it has a lot of regular companies which are not doing as well, and not as volatile too. And a lot of them are safe. So the Nasdaq and the S&P, as soon as the market really wants to go down, it could be more violent, and it could start to show that bearish SMT ahead of the Dow. And that's what I like to see, because that's the ones I trade. So, but we're seeing that the Dow now is a lot more higher. If you look at where the Dow is compared to where the Nasdaq is, and yes, now it's really starting to go higher. So we can go investigate that in lower time frame. So we're gonna remember that yellow SMT there, and we're gonna go down to. We could drop down to the hourly chart. You see what I'm talking about? How much higher the Dow is? It's a little easier to see now. So obviously the Nasdaq doesn't really want to go up. It could be pulling the Dow down. And the Dow today actually has, it's pretty scary. You see how the Nasdaq went lower, and the Dow just went up. Now that right there, see how the Nasdaq made a lower low, and the ES made the higher highs. Now the bodies didn't really make the higher low. I look at the bodies, but the bodies are much higher on the Dow and a little bit higher on the S&P 500. So This is obviously showing that the Dow is the bullish leader here. We could be seeing a reversal, and I think the SMT that we saw, the higher time frame one, this is fake SMT. Nasdaq could be catching up to accelerate lower. That is a possibility. I'll go down to the 5 minute. We're not gonna do anything just yet. We're still inside this overall consolidation. If I look at this whole day, really, on the 15-minute chart, you can see it well. So, am I absolutely confident with what's gonna happen? No. Not yet, at least. Powell's speaking in about 4 minutes and 20 seconds. So, that can obviously change a lot of things. It's Powell after all, and he loves to speak. But he never says anything important. It really is unfortunate. What? Oh. I thought it was going to show some working out stuff. Oh. I didn't mute the mic, but I'm trying to get on Powell what he's going to say. But I never know what to search up. Fed speech live. I searched that up before. Okay, there you go. I found it. By the Federal Reserve. They have a YouTube channel, of course. Are they going to take over YouTube too? And the chat's disabled. Now, I think the Fed has been on a blackout. That's what some people were saying. I wasn't really aware, but I mean, I guess they were. I mean, like, they couldn't really say anything. I don't know why, because they never say anything smart anyway. Maybe just because that's the reason that they wanted to limit how much the Fed talked, because, I mean, they don't really say much. So they didn't want them to say anything stupid. No, I'm kidding. It'll probably be the same old. He's probably gonna come on and say, "Hey, you know, we're still looking at inflation. It's looking good. There's nothing that worries us. You know, we saw the GDP, and you know, we're not worried. We're gonna be reducing quantitative tightening and stuff, regular, as always, just like last time. I don't think he's gonna try and freak out the whole market. Price is going up ahead of him speaking though, so maybe he says something that makes price crash. But I'm not favoring that view. I'm favoring. I think that off this drop, many people have made money. I mean, have not went higher really to grab any level of buy side all week. So I think there's lots of buy side liquidity in this range, and not many people are expecting a big retracement higher. And so I probably won't take part in this at all, but we're probably going to see another range higher. So we like start speaking, we might retrace a little bit and see another range higher. I am noticing how maybe the S&P looks different. Okay. Well, the S&P is a little different. There's a fair value gap there. So I'll be watching that one. There's a tiny one on the NASDAQ. Yeah, press conference starting right now. Powell is about to walk on stage. Wait, why is this Bitcoin? What? Completely forgot what I was. Okay. He's late? Is he late? The algorithm's gonna run without him. Okay. Oh wow. Oh wow. Okay. Maybe I should.
Labor market that benefits all.
You should. This recording should
Today,
be able to
the
hear
FOMC
him.
decided to leave our policy interest rate unchanged and to continue to
He said
reduce our
inflation is
securities
still too high,
holdings, though at a slower
which
pace.
is normal.
A restrictive stance of monetary policy has been putting downward pressure on economic activity and inflation, and the risks to achieving our employment and inflation goals have moved toward better balance over the past year. However, in recent months, inflation has shown a lack of further progress toward our 2% objective, and we remain highly attentive to inflation risks.
Yeah.
I'll have more to say about monetary policy after
So everyone's
briefly
talking
reviewing
about
economic
inflation risks,
developments.
Obviously. I think they're just
Recent
addressing that a
indicators
little bit.
suggest that economic activity has continued to expand at a solid pace. Although GDP growth moderated from 3.4% in the fourth quarter of last year to 1.6% in the first quarter, private domestic final purchases, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal on underlying demand, was 3.1% in the first quarter, as strong as the second half of 2023. Consumer spending has been robust over the past several quarters, even as high interest rates have weighed on housing and equipment investment. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year.
I'm going to sound stupid.
The labor market remains relatively tight, but supply and demand conditions have come into better balance. Payroll job gains averaged 276,000 jobs per month in the first quarter, while the unemployment rate remains low at 3.8%. Strong job creation over the past year has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a continued strong pace of immigration. Nominal wage growth has eased over the past year and the jobs to workers gap has narrowed, but labor demand still exceeds the supply of available workers. Inflation has eased notably over the past year, but remains above our longer-run goal of 2%. Total PCE prices rose 2.7% over the 12 months ending in March.
I can't trade that.
Excluding the volatile food and energy categories, core PCE prices rose 2.8%.
It just moved 100 points.
The inflation data received so far this year have been higher than expected. Although some measures of short-term inflation expectations have increased in recent months, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are strongly committed to returning inflation to our 2% objective. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings, though at a slower pace. Over the past year, as labor market tightness has eased and inflation has declined, the risks to achieving our employment and inflation goals have moved toward better balance. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We've stated that we do not expect that it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. So far this year, the data have not given us that greater confidence. In particular, and as I noted earlier, readings on inflation have come in above expectations. It is likely that gaining such greater confidence will take longer than previously expected. We are prepared to maintain the current target range for the federal funds rate for as long as appropriate. We're also prepared to respond to an unexpected weakening in the labor market.
All the price is doing right now is chopping.
We know that reducing policy restraint too soon or too much could result in a reversal of the progress we've seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment.
That's what I've been telling, what he just said.
In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks.
2024.
Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate.
They wanted rates to come down.
We will continue to make decisions meeting by meeting.
Be bullish. Now, a lot of
Turning to our balance sheet, the committee decided at today's meeting to slow the pace of decline in our securities holdings, consistent with the plans we released previously.
And there you go. See,
specifically, the cap on Treasury redemptions will be lowered from the current $60 billion per month to $25 billion per month as of June 1.
The amount of decline
consistent with the committee's intention to hold primarily Treasury securities in the longer run, we're leaving the cap on agency securities unchanged per month, and we will reinvest any proceeds in excess of this cap in Treasury securities. With principal payments on agency securities currently running at about $15 billion per month, total portfolio runoff will amount to roughly $40 billion per month. The decision to slow the pace of runoff does not mean that our balance sheet will ultimately shrink by less than it would otherwise, but rather allows us to approach its ultimate level more gradually. In particular, slowing the pace of runoff will help ensure a smooth transition, reducing the possibility that money markets experience stress and thereby facilitating the ongoing decline in our securities holdings that are consistent with reaching the appropriate level of ample reserves. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Okay, well, you've done, that was actually pretty quick.
Thank you. Howard Schneider with Reuters. A question to follow up, if I could. Do you consider the current policy rate still, are you confident that it's sufficiently restrictive to get inflation back to 2%?
So I do think the evidence shows, pretty clearly that policy is restrictive and is weighing on demand. And there are a few places I would point to for that. You can start with the labor market. So demand is still strong, the demand side of the labor market in particular. But it's cooled from its extremely high level of a couple of years ago. And you see that in job openings. You saw it, more evidence of that today in the JOLTS report, as you'll know. It's still higher than
JOLTS
pre-pandemic, but it has been coming
No,
down
take a look
both
at
in the
that.
Indeed report and in the JOLTS report. That's demand cooling. The same is true of quits and hiring rates, which have essentially normalized. I also we look at surveys of workers and, surveys of workers and businesses and ask workers, are jobs plentiful, and ask businesses, are workers plentiful? Is it easy to find workers? And you've seen that the answers to those have come back down to
Like I said.
pre-pandemic levels. You also see in interest-sensitive spending like housing and investment, you also see that higher interest
No.
rates are weighing on those activities. So I do think it's clear that, that policy is restrictive.
Watch this.
Sufficiently restrictive, I guess, is the
So
Valley Gap.
I
It's
would
not
say
going to stop. It's
that we believe it
probably
is
gonna go
restrictive,
through it,
and we
but it
believe
might
over time
find a
it will
little
be
bit of
sufficiently restrictive.
resistance.
That will be a
Consolidate.
question that
you're
the
in a
data will
trade-
have to answer.
So as a
Yeah.
follow-up, if inflation
Pardon me.
continues
I'm
running
in a
roughly
trade
sideways,
from
as it
down
has
here.
been,
And I'm holding
the job
price,
market
and I
stays
see it
reasonably
might come
strong,
down a
unemployment
lot,
low, and
but
expectations
gonna
are
be scared,
anchored
'cause I
and
know that
maintained, would you disrupt
bias
that
is.
for,
Expectations
I
are
don't care
not
what
anchored.
policy
or
is.
anchored?
Or anchored.
Stable, roughly?
I'll explain.
Would you
I'll break
disrupt
down some
that
of
for
what
the
he
last
said.
half point on PCE?
You know, I don't want to get into complicated hypotheticals, but I would say that, you know, we're committed to retaining our current restrictive stance of policy for as long as is appropriate, and we'll do that.
Gina. Thanks for taking our questions, Chair Powell. I wonder, obviously, Michelle Bowman has been saying that there is a risk that rates may need to increase further, although it's not her baseline outlook.
All the people
I wonder if
with
you
puts
see
right now
that
are
as a
crying.
risk as well, and if so, what change in conditions would merit considering raising rates at this point?
Everyone with that.
So I think it's
Powell is
unlikely
going
that the next policy rate
prices
move will
down.
be a hike. I'd say it's unlikely.
Crying.
You know, our policy focus is really what I just mentioned, which is how long to keep policy restrictive.
I'm crying because Powell.
You
was
ask what would it
speaking,
take? You know, I think
As
we need to
always.
see persuasive evidence that our policy stance
doesn't
is
make
not
any
sufficiently
sense.
restrictive to bring inflation sustainably down to 2% over time. That's not what we think we're seeing, as I mentioned. But that's something like that is what it would take.
What
We'd
is
look
this
at the
so far?
totality of the data, answer to that question.
200
That would
points.
include inflation,
I would
inflation
be
expectations, and all the other
happy
data
with
too.
that. I think so.
Would that be like a reacceleration in inflation?
Well, I think, again, the test, what I'm saying is, if we were to come to that conclusion that policy weren't tight enough to achieve that, so it would be the totality of all the things we'd be looking at. It could be expectations, it could be a combination of things, but if we reach that conclusion and we don't see evidence supporting that conclusion, that's what it would take, I think, for us to take that step.
Chris.
Take that step to what? Wait. I didn't hear what she said.
Our policy stance is not sufficiently restrictive to bring inflation sustainably down to 2% over time. That's not what we think we're seeing, as I mentioned. But that's something like that is what it would take. We'd look at a hike. I'd say it's unlikely
Just one?
that the next policy rate move will be a hike. I'd say it's unlikely.
Oh, wait a minute.
You know, our policy focus is really what I just mentioned, which is how long to keep policy restrictive of
Okay.
risks, as
So-
always. And we'll
To break down what he said, is basically what that question just asked is, can the next policy statement be a hike? And he said it's unlikely, but he did mention how it's possible that we see things that might lead us to actually hike. So that's pretty alarming, because that means that on the Fed's mind is that, it's possible they may hike any moment. Any month now they could start saying, hey, inflation's up, we're going to start to hike. But until then, they're saying that as of now, there's nothing that tells them that they need to hike. Right? And what they're really doing is, when there's inflation, you can to combat inflation, you can either print more money, right? So if things get more expensive, you can just print more money and buy more assets. And that will help balance things out. You can get other countries to do that, to buy your bonds, basically get more people into government loans. The bonds are basically loaning the government money. And that pushes up asset prices too, and helps cool down inflation. There's also hiking the rates, right? So what that does is in effect gets more people to buy bonds. It's just as countries buy other bonds, or more people, because when the rates get pushed up, you'll see mortgage rates go up. You'll see. Why do I have a play on my chart? Sorry about that. I need to take care of this. I hate having things on my chart that I don't know what they are. Like this. No, it's not that one. It has to be in here. No. It has to be up here. Oh my lord. Okay. It is up here. What are you talking about? Okay. I'll have to find it after later. But what was I talking about? Yeah, when you have higher interest rates, your bonds become more attractive to the public because the interest rates for the bond, they go up. So people get a higher rate of return, which means that also prices, which are they're inverse to the yield, the prices also go down, so they become more attractive, cheaper to buy, and you get a higher rate. So a lot of people sell their bonds. Oftentimes it creates even higher rates and lower prices in the stock market, and in all assets overall, because they're selling the bonds, their current bonds and their current stocks and their current whatever assets they're holding to get take advantage of the new rate. Like if the Fed pushed up the rates all the way to 15%, and you got 15% a year on like a 10-year bond, that'd be incredible. Everyone would want that one, and so they would buy it so quick. The rates would go up, and it would, it would basically give a lot of money back to the government. The government would make a lot more money, and they would be able to help that would help cool down inflation. At least that's the way I think of it. That might be flawed, but I mean, I don't think it is. Or then if it is, I have to revisit a whole lot of things. But then there's quantitative easing and quantitative tightening, which is basically the government doing this themselves. Quantitative easing is buying up securities, right? Bonds, assets, in the stock market, whatever. And quantitative tightening is just selling those assets, right? Those assets go onto the Fed's balance sheet, where they hold all those assets there. And so basically the Fed will have, all their assets and all their liabilities, which could be their debt or whatever securities they bought on their assets. And when they start to do quantitative tightening, they're basically just selling their assets, right? And what they were doing is they were selling their assets at about 50 billion, 60 billion a month. And now they went down to about 40 billion. They reduced it by a little bit. And what they just announced is that they're continuing to do that. So they're not reducing it more, but they're continuing to reduce the amount of quantitative tightening they're doing. So they're not immediately going back to quantitative easing, but that's what they're slowly doing. Because the more you do quantitative tightening, right, the more inflation will go out of control. The harder it is to control inflation. The more quantitative easing you do, the easier it becomes to control inflation. And the more quantitative easing you do, the better it gets. But that quantitative easing, someone needs to pay for it. Either inflation will eventually, the debt's just going to go out of control. It's just going to get bigger and bigger and to create a bigger bubble. Or the taxpayer is going to have to pay for it. And the taxpayer is not going to pay for it because they're already paying so much. And so what it basically becomes just like heroin. You're basically just doing heroin. This is what the government's doing. They're doing heroin. And they can't stop. Because if they stop, people will lose homes. Banks will go out of business. They won't be able to bail them out. Every major bank will fail. Almost every single one. Everyone will lose their money. It's going to be like a big reset. And the dollar is not going to have the reserve currency anymore. And that's what really all this is about, is the reserve currency, the GDC, global reserve currency. GRC, not GDC, GRC, global reserve currency. That's like the ring of power, right? Like in Lord of the Rings, the one ring to rule them all. That everyone wants the dollar when it's the global reserve currency backed by nothing but what the United States decides to print. So basically, the United States is able to print gold, and everyone wants that gold. That's what it happens when the global reserve currency is a paper currency that's artificially created instead of a real material like gold or silver. That's what happens. You have complete control over the global economy, and no one is ever going to give up that power in a million years. And so, if that means creating debt, so much debt to the point where countries like China and Russia are upset and they want to move away from the dollar to create some BRICS nations, that's what it's going to take. That they're going to run up the debt, and they're going to run up taxes, and do whatever they want. They're going to put price controls, do whatever they can to hold on to that power. It is literal heroin. So, so far, we are hitting this. Take this out because we just went right through it. We're coming up to this gap from yesterday. Right, we're watching that breakaway gap. And by the way, like, I'm not executing on anything because I didn't like how I looked back here. I could tell it was likely to go up, but because of how fast it was moving, I said, hell no. Now would be the time where I would want to trade. Like, now it's moving a little bit better. It's not moving as fast. It's starting to slow down a little bit. It's still moving pretty big ranges, but more something where I'm comfortable trading in. However, we're so far above the midnight open, and I don't have a short bias, so I'm not looking for anything. It might run back down and trade to some of these lows, but ultimately my bias is higher, and I don't want to be trading this far above the midnight open. So I already accepted a very long time ago, as soon as I don't know, it was around here, that I was going to be done trading. But yeah, so I mean, the Fed is just digging themselves a hole. It's a never-ending hole, and every time Powell comes on to talk about it, it's just the same thing he says, and it doesn't move price what he says. The fact that he is speaking, yes, brings volatility, but it's not what he says. Price was going down, up, down, and it was for a little bit kind of going in on what he was saying. He said something bad, it would kind of go down. He said something good, it would go up. Do you really think that billionaires are sitting behind their screens, multi-billionaires, and they're placing in orders based on what he's saying? No. They know it. They know what he's going to say ahead of time. They have the script. It's a script that he's reading off of. And they're not going in there buying and selling off emotion. That's the stupidest thing you could ever think of. Do you really think that multi-billionaires are going into the market and they're buying and selling based off what another man says? That's emotion. Or that it's a fight between the buyers and the sellers, and that they're going to war? No, that's some child stuff. What's really happening is that the algorithm was chopping around until he was done speaking at around 38. What happened at that time? Bam! It just started running. It finally picked the direction. It went to question time, and the real work began, where the real algorithmic delivery was higher, and that's what I said it would go. That I said, this morning, which I will include with this video, it would go higher. I could have bought this morning. Why didn't I buy though? Because that's not what I do. I'm not trading for the sake to make money. I'm trading because I like trading. I enjoy trading. I really do. I mean, why do you think I'm making videos all the time? Well, maybe not all the time, but still, I put quite a lot of effort in videos and journaling. It's not just because I want to make money. It's because I honestly love doing this. I have a passion for it. I love just sitting here talking about the charts, looking at the charts, not even trading them, just looking at them, and basically predicting the future all the time is honestly a passion of mine. So simply my model wasn't there, and this means don't trade it, and I'm okay with that. I'm able to just let that go and just live another day, you know. But anyways, nothing really. I mean, I want to sit and wait till it hits that breakaway gap. Really tempted to do that, but I do need to go to the gym today, and I might be able to help my mom with something before I go. We're in the process of cleaning up the house. My parents are moving, so I might be able to go do that. Let's look at how the S&P is looking. Well, we entered that fair value gap on the S&P. Almost back to daily highs. And the Dow also almost back to the daily highs. How is that daily chart looking? How would you feel if you had puts? Really, how would you feel if you had puts right now? You closed them up on Friday. It'd be a whole roller coaster, I'll tell you that. I mean, yeah, you might still make money if you have puts expiring Friday, but, you know, because NFP could just destroy this whole range, right? NFP Friday, but it would not feel good, I'll tell you that. It would not feel good. Now, what's happening here? Every time price gets up above a short-term high, you're retracing. I don't really like that at all, and that's like a seek and destroy. What I think it's waiting for is the last hour macro that ICT mentions. I don't know why he doesn't say 1450 to 1510, but the last hour or maybe it's because I'm on the 5-second chart. Yeah, that's probably why I'm seeing a seek and destroy environment. But the 1 minute, 5 minute, I mean, I can always retrace and still go higher. Preferably though, I would want it to leave these breakaway gaps, and kind of like it left this one down here. I didn't want price to come back into here because that would be a lot less bullish. I really wanted to expand higher, and so I didn't want to see anything underneath that low or like these order blocks. But yeah, how's Bitcoin doing? Bitcoin's recovering from its losses. It was doing a triple bottom, and it entered into a discount of this gap. So Ethereum, SMT, gold is being pushed up. Oh, wait a second. how's the dollar doing? Let's see that. And the dollar's still in consolidation. Tough one, huh? The dollar. It's absolute consolidation. Now, I don't know. I saw on a recent Ice-T stream there was this emoji thing he did. Okay, now I don't know how to do that. I have no idea how to do that. But it hit. So I'm gonna close it here. My brother just knocked on my door. He's getting a little impatient. So I'm gonna close up the stream and have a very good rest of the evening. Don't try and be too destructive in the last hour. If anyone is still thinking that this is tradable, in my opinion, this is not tradable. It means done. It can keep going higher and stuff. It probably will until the close, but that's the end of that.